him, and we really thank you all for joining us. And we'll hold Q&A for the end, but out of respect for everyone's time, we're going to try to keep this to about 30 minutes, and hopefully we have some good questions here at the end. So without further ado, Charles, if you don't mind taking over.
Great. Thanks a lot, Dean. And it's great to be here with everyone tonight. I just a couple of housekeeping items. If you do have a question, I think you can drop it in the chat, and I'd love to hear from you. It's always great to have a little bit of interactivity to know exactly what you're thinking and the questions that you have. So looking forward to addressing those at the end of my comments. And I think another thing that I would say here is with so much in flux in the broader environment, things changing rapidly, policy changes, everything going on in the markets, it's hard to make slides. So a lot of our slides need to catch up to the environment. So if I'm sort of off course talking about something that's not in the slide, just bear with me a little bit. But in that vein, and just considering a very short 3 weeks in 2026, one of the things that we had been hopeful for, and we talked about this a lot in our December webinar, was that we thought that policy volatility would slow down a little bit in 2026. And exactly the opposite has happened. So I would almost characterize it as not quite as bad when the current administration took office as last year, but certainly at a fever pitch. And the biggest issue continues to be from a market perspective, right? So we have to separate policy and market. The biggest issue that is impacting the markets is tariffs, right? So you saw the big decline in the market on Tuesday when we talked about retaliatory tariffs on Europe based on the situation with Greenland. And so that's what we're really keyed into from a market perspective. And we think that'll continue to be something that impacts the market more than other policy situations. So if we think about where we are from an economic outlook perspective, I'll go through some of these points. I'm sort of breaking every rule of slides here by putting a lot of text, but I'll sort of pull some things out here that we think are very important. The growth outlook, and we got the GDP numbers today, incredibly high levels of growth in Q3. So we were looking at about a 4.3% advance. The release today came out at about 4.4%. What's driving that? It's still personal consumption. It's still spending. So when we look across the economy, it's still very healthy. We still have wages that are rising, and that's definitely showing up in the growth outlook. It's also showing up in corporate earnings, which we'll talk about in just a little bit. So I mentioned the consumer, the spending component, but household spending does remain the foundation of U.S. growth at this point. And it really is showing no signs of slowing down whatsoever. It's still running at a 2.5% to 3% type of level. And so even coming out of the Christmas season, the shopping, everything that we saw at that point, it still continues to be robust, which actually surprised us a little bit. We thought we were going to see somewhat of a dip, but we just haven't seen it. Some other big factors here, inflation. Again, we got more data today on what we call personal consumption expenditures, or PCE. That data was very positive. It came in at about 2.7%, so well below that 3% threshold that we spent a lot of time last year above. So it is under control. It's not close to that target level of about 2%, but it also isn't forcing the Fed's hand in any way. So before this week and some of the things we saw out of Japan and other areas, interest rates had been very stable, and that's a good environment for fixed income returns and the other part of your portfolio outside of your equity positions. What has been a concern has been the labor market, right? So we have seen that slow down quite dramatically, but the flip side of that is that productivity has been growing almost at a 5% clip. So when we think about technology beyond just the market impact, what's happening is that we're becoming more productive. So far, we've had sort of this no fire, no hire state of the labor market. And we think it can continue with sort of this sub 100,000 level job growth on a month-to-month basis. But we're a little concerned. We're going to be watching those trends, but generally, we don't think it's derailing anything at this point. We talked about policy a little bit. It does generally continue to be noise. After the close today, we're up 1% on the S&P 500. Global markets have been doing very well. If you take the Eurozone, for instance, it's up around 3 to 3.5%. Look at a market like Japan, up about 4.5%. So a well-allocated global diversified portfolio is doing just fine so far this year, despite some of the policy noise. So I think the bottom line for us, just from a broad perspective, is that the economy is normalizing after we've had this huge leadership coming from the US over time. So what does that mean, right? It means that there are actually what we think are more opportunities to diversify a portfolio globally than we've seen in quite some time. So even though we're getting a lot of volatility and this can be a very tricky environment, we do think it presents some pretty interesting opportunities for portfolios. And if you know RBC Rockdale, you've probably seen this page before. So I won't spend too much time here, but a couple of things I wanted to highlight. I said I'd talk a little bit about corporate profit growth. And this was an area we actually thought was going to kind of have a little bit of negative momentum as we got into the back half of last year. And exactly the opposite happened. And if we're looking at forecasts for corporate America as we move through 2026, you're talking about sort of a low double-digit expectation that continues to move higher. So I just checked it before the call. We're in the middle of Q4 earnings season, but the expectations for the full year in 2026 are about 14.4% on the S&P 500, which is tremendous, right? That's compared to kind of an average level on corporate profits, somewhere around 7 to 8%. So we're almost doubling that in the current environment, and margins have shown no sign of really going down whatsoever. So corporate profit growth, we think, is going to be a very good driver of the global equity market going forward. The other thing, and this might be a little interesting to take a look at, but what we did actually upgrade in our December webinar was our geopolitical risk speedometer. So we had been in the red zone on that for quite some time, but based on the resiliency of the market and tying that back again to the impact on stocks and bonds, we're seeing very little impact and very little pass through from these policy decisions on overall portfolios, except if you bring tariffs into the conversation, right? So that's really what we're keyed on. But we think the market, based on the fundamentals that I've gone through at this point, where corporate profits are and what we're seeing, can continue to move higher, even in the face of a lot of that policy noise. And when we think about our forecasts, running into 2026 from 2025, 2025 was a year that surprised a lot of people. Growth was a little bit higher. Corporate profit growth was very good. Inflation wasn't quite as high as we expected going into the year. And then Fed funds was slightly lower, right? 3 cuts, around 3.5 to 3.75%. And I think the story in 2025 was just how stable interest rates were after that Q1 and Q2. So fixed income had an incredible year last year. I think anywhere from about 8 to 10%, whether you were in very high quality, what we'd call investment grade bonds, or whether you were in more lower quality or high yield type of bonds. Both of those markets did very well. And then for 2026, we do see a follow through on growth. So again, going back to that GDP print, 4.4%. Most expectations, coming into this year is that we're going to be a little bit higher, but the measures in real time. So there's a measure called the Atlanta GDP Now number coming out of the Atlanta Fed. That's actually running at 5.4% for Q1 of 2026. Now, there's not a huge correlation to real and to predicted, but that's a massive number, and directionally it tends to be correct. So we do think that the consensus estimates here are pretty spot on, and we're going to see a pretty good growth backdrop over 2026. Keep in mind, you're going to see a dip coming out of Q4 based on the government shutdown that we went through and some of the spending that pulled on. So we're not even going to see this until the back half of the year, which we think bodes pretty well for stocks once we get through the summer. We talked about corporate profit growth. We're in that 11 to 13% range. Broader market at about 13.7% at the last update of this page. Remember, it's 14.4% looking in real time today. And then we do expect inflation to be right on where it is today, which is about 2.7 to 2.8%. We think it's going to be in that 2.5 to 3% range for the full year. And we do see the Fed cutting another 2 to 3 times. A lot of this has to do with the housing market and the affordability on that side of the coin. But we could definitely see them cutting 2 more times. We'll see if we get a third. But again, that is another tailwind in terms of liquidity in the market. When we're thinking about how asset classes move, that could be very helpful. And then on a 10-year treasury basis, we're at about a 4.25 on the 10-year now, which is a little bit surprising. Still just marginally within our range. But we do think the environment here is pretty good for bonds. If you stay at that 3.75 to 4%, your yield levels are going to be pretty good. And that's going to match up well to provide some balance against what we see on the equity side. Now, it's always difficult to talk about some of the shifting and changing global dynamics. And a lot of what we see from the current administration clearly creating a lot of rifts when we think about Europe, which has been the most recent example over the situation for Greenland. But we think generally over 2026, the things that are going to matter, and we talked about some of these, but it's going to be labor, it's going to be inflation, it's going to be government policy, and it's going to be the Fed. We think these are the elements that if you see policy start to impact, where we could have some potential changes in the market tone. So if we just go through each one of those, I talked a little bit about labor, but if that productivity were to start to ebb, that could certainly be a risk factor. At this point, we don't see that happening, but that's certainly probably number one on our list for what could derail the potential equity rally today. We talked a little bit about inflation as well, but we see that actually more as a positive tailwind, and the risk that it could be below our forecasts, we think is higher than the risk that it'll be above our forecasts. On the government policy front, anybody's guess as to what actually ends up panning out with all of these things. But what I would encourage you to think about is a lot of what the follow through could potentially be is constrained still by things that would have to be done in Congress and still by striking global deals. So if I think about the current situation that we've gone through here over the past week, it still was headline discussion. There was no specific follow through for some of the initial administrative policies that could have gone into effect. And again, we've seen that movie so many times now. You get some destabilization, you have an issue on the global stage, it gets walked back, then an agreement or the outline of an agreement tends to emerge at that point. Now, I think we could all agree we'd like to see that process be very different and less out in the open. But it may be just an evolution of how we are evolving as a society. We're using a lot of social media. It's easy to get in touch with each other instantly. You can get out there in the public sphere very quickly. And so I think it's just a matter of getting used to seeing policy conducted in this way. And again, it's noise at this point for most of the policies that we do see. And then there's the Federal Reserve, where we did get a ruling today. We had the Supreme Court essentially say that Lisa Cook, who Trump had gotten into a little bit of a rift with earlier in 2025, needed to stay on the Federal Reserve. So that's a big win when we think about debt and deficits and the independence of the Fed. There's a lot of institutional support for ensuring that it remains independent. And at this point, if you look at where we are now, Powell will transition out of his role of chair in May, but the only position he'll actually be able to replace is Stephen Moran's position, where it's coming due at the end of this month. So there's much less influence that's actually occurring at the Fed than what I think a lot of the headlines would predict. But these are the things that we think will be meaningful for returns over 2026. And we talked a little bit about, again, the Fed and being at the crossroads of policy and leadership. But just to kind of back that up with some things, you have consumer price inflation down in the right hand here that's really advancing again between that 2.5% and 3% type of level, which when the Fed thinks about cutting interest rates, inflation being stable and being in this range that's a little bit lower gives them the room to do that. If you look at the top right chart, that's the unemployment non-farm payroll. So that's the monthly report that we get every month. Now, they're seeing a lot of concern on the unemployment side, and they're seeing a stabilization on inflation. So there's no immediate reason for them to cut, but this will become a much bigger deal as we move through this year. And we think is the primary reason why we're going to see some insurance cuts from the Fed, which is going to be positive for markets. So let's talk a little bit about spending and get a little bit into the consumer here. So I like these charts because it helps us deal with this K-shaped economy story that's out there and what's actually occurring for individual consumers in the US. So take your eyes up to the top left where we have net worth change in value. This is showing different percentiles of net worth across the US economy. So on the far left side, you have 0 to 20% of the lowest, right? And then you have 99 to 100% representing the highest levels of net worth. Now, I want you to pay particular attention to this. If we look all the way on the right, those numbers are a lot bigger. The wealth is a lot higher. But look at that 0 to 20%, right? The bottom 40th percentile is actually up about $1.7 trillion. So their actual net worth compared to pre-pandemic and then post-pandemic has actually risen as well. And it's actually risen on a percentage basis much higher than what we see in that 80 to 99 percentile. So at RBC Rochdale, when we think about the K-shaped economy and we look at the amount of income and how that's increased against the level of inflation, we actually don't see as big of an issue with the bottom cohorts here. They have benefited from a lot of the market moves that we've seen, and certainly from a wage perspective, their wages have actually risen much faster than what we see in some of the upper cohorts. Now, if we take that through and think about actual spending, so what's the percentage of total that each one of these areas is actually contributing to the economy? Even though those wages have gone up and you do have spending that's a lot higher in those lower parts of the market, it's about 9.1% of the share of spending across the economy. Now, 60 to 100%, looking at those percentiles, it's about 80.5%. So there's a lot of insulation built into these consumer numbers. And at the end of the day, and this is a really important concept, even though inflation is up and we have headline news around a lot of goods in the economy being more expensive, wages have actually risen faster. So wages are up about 8% more in the aggregate relative to what we've seen with the price increases post-pandemic. So that's a really important thing to consider when you're trying to justify why consumption continues to be so good. The other thing that's pretty interesting to us is stepping a little bit away from the sentiment on the consumer side and thinking about how businesses are actually perceiving the economy. And on the bottom left, you can see the Small Business Optimism Index. This has actually been pretty much increasing off the lows that we saw in 2023. And one of the best performing asset classes so far in 2026 has been small cap stocks, which tends to be a leading indicator of what's happening with growth potentially picking up here domestically. So we see that optimism chart starting to move a little bit higher. That's another good sign. And then thinking back to earnings and tying it to business spending and CapEx, and we've heard a lot about this with respect to technology and artificial intelligence, it does continue to climb. So when we really dissect those GDP numbers today, we always take a look at construction, which shows us exactly what spending has been on data centers across the US. That number continues to advance. It remains at around 15 to 20%. So this story here on spending is still intact. So getting through the tariffs, we think we're in a very similar position to where we were before the administration transitioned in 2025. Now let's take this more and think about the market and sort of move away from the macro a little bit. We talked a lot about earnings, where our forecasts are, but let's talk a little bit about valuation. And we're going to start to formulate sort of what we're doing here in the US and the trends that we believe are still going to be intact here, but then where we are complementing those exposures in terms of portfolio construction. So there's no way to slice it. When you look at US equity market valuations, they are very high. If you look at that chart at the bottom, they're essentially almost about 5 to 6 points over where the 15-year average is. What this means is the market isn't going to drop tomorrow, but when there is volatility, especially like what we've seen over the past week or so, you're going to see the equity market move pretty dramatically. If we had lower valuations and we were coming off a different type of an environment, we might have some more resiliency in that day in and day out. But because of where we are in valuations, we have much more sensitivity. So it's not a reason to sell the market, but it is a reason to be prepared for additional volatility that we think could hit at any given time, as we've learned from just the first 3 weeks here. So, why do we think the US market is still a pretty good place to be? And it really gets back to technology. These stats are really breathtaking to me. If I look at the left chart here, what you're seeing is the Magnificent Seven revenue on a quarterly basis across all 7 of those companies. That's at around $600 billion a quarter. That's about 9% of US GDP and climbing. So when you think about the contribution to the economy from these tech companies, it's tremendous. Now, go with me to the top right corner and take a look at some of the technology spend that we look at as a percentage of GDP. In different areas and different times going back to the 1950s, right? The first big technology bump up that we saw was the invention of the PC and IBM's first PC back in around 84, 85. That was about 2.5% of GDP was on tech spending. Now, if we fast forward that, we think about the 1999 and 2000 type of environment, we were at about 2.9%. Right now, we are accelerating, but we're still at about 2.1% of GDP just on spending, right? So there's two distinctions here. We've got companies that are making a lot of money, 9% of GDP. That's a lot of money, $2.4 trillion. We have spending of those companies that's still not up to a level that we've seen in previous tech booms. So again, concluding that the equity market here probably has some more room to run before we get really nervous about a pullback, significant pullback in technology. And then just to put the icing on the cake there, when we think about generative AI and coming into the market and how much it's actually producing from a revenue perspective, the projections for about the next 7 years have it almost going up 6 times to about 1.8 trillion dollars. So these numbers are real, and I think it's a pretty big delineation. And so no matter what I'm about to say about global markets and positioning, the message is not sell the US and leave. The message is the US is still a good place to be, but we think that a lot of what's happened over the past year has sparked opportunities in other areas outside of the US that we think complement a portfolio position. So we take a look at some of the dynamics that are occurring. You can't deny that some of the relationships the US has with other countries in the world are breaking down a little bit. That doesn't mean it's a terrible thing, but you do have a rethink of how a lot of these multinational organizations are actually working. And so what that's actually sparked is a hard look at some of the comparisons between what you can get in a global market and what you can get here in the US. And so a couple of things that we think are really important to look for. In the top left chart here, when we think about budget deficits as a percentage of GDP, and we're just really looking at the US and the Eurozone here as an example, the Eurozone is in a much better position in terms of spending and budget deficits. In a sense, they have a lot more room to spend. Then when we think about general government debt as a percentage of GDP, which has been a huge topic going back to last year and thinking about it this year, global markets are in a much better position as well. So they're under a 100% type of ratio, where we're continuing to climb around that 125 to 130% level. So the way to think about that again is there's more room for global markets to be spending. You can also think about it as there was a lot of reliance on the US to spend to really prop up that global market. Now that responsibility is shifting to these economies and to these nations individually, which again create different opportunities based on the level of spend and again what's occurring from a growth perspective. So that's a real big one that we think is driving a lot of the differentiation. The other thing, if you look at the top or on the right-hand side here, just the rebalancing of global capital flows. A lot of investors are still very underinvested in international markets. And so we think as things shift here, especially in the first quarter, when you see a lot of position changes, that's going to benefit those markets. If we look at it technically, so just take valuations and sort of mean reversion into account, that also looks like a pretty good tailwind. You have significant discounts in international markets relative to the US, and we do tend to see when they get wide enough, these mean reverting types of behaviors. The last thing that I'll mention on this, and then I'll move into some of the specifics, but there are very good sector and structural advantages to being in international markets. The first is the sector composition is just different. So you get a lot more defensive stocks, a lot more income-based stocks in international markets. Think financials, think industrials, and the tech exposure in international stocks is much lower. So you almost have built-in insulation. If you do see volatility and you do see tech stocks suffer in the US at any point going forward, you're going to be able to pick up the pieces and balance that out with that global allocation. And so just to move through this slide really quickly, in thinking about valuations, global versus US, on the left-hand side, we have price to earnings, right? If you look at the Mag 7, the S&P 500, compared to pretty much just any other global market, you definitely have a valuation advantage in terms of the base you're moving off of for returns. On the right-hand side, it puts this in, I think, a very good context. So it shows the discount that international equities have gone to with respect to US markets. So if we look at that same price to earnings measure, you have about an 8-point gap now between where the US is, think about 25 to 26 times, to where international markets are, think 17 to 18 times. So we do think that there's a good reason from, again, a structural and valuation perspective that international markets can make some sense. The other thing that we think could potentially turn out in sort of non-US or global favor here is if you think about what the administration has sparked in terms of some of these relationships. Think about defense in Europe, right? They now have to start spending a lot of money to protect themselves as sort of an aggregated European Union. That's going to drive a lot of spending, and that's going to filter down through to growth. So some of the positive outcomes, I think, for other countries is that there's almost an opportunity here for them to reinvent their markets and reinvent how they think about growth. But it's always the case. If you look at where spending is the highest, right? So we think about that fiscal impulse from the government spending money. After 2008, those are the areas that have tended to perform well. So I do think there's a little bit of this growth handoff, even though it looks pretty good here in the US, from the US to the rest of the world. And that's what's illustrated on this chart. So if you take something like Germany for perspective, for good perspective here, in Q1 of 26, very light growth. We actually just figured out in Q4, Germany had the first expansion of GDP in about 2 years. But you can see how that growth ramp is accelerating. And when we see a growth ramp that's accelerating quicker on a relative basis to another economy, if you look at the US right there, that is a good tailwind, again, for markets in those areas. And then the last thing on this sort of valuation gap and comparison is really getting into those structural components. So on the left-hand side, what you see here, we're calling it sector skew. All this is saying, okay, how much is the S&P 500 exposed to information technology? How much is the broader global market exposed? And so if you look at that first box, 35% of US markets in the S&P is exposed to information technology. If you look at the broader global market, it's about 15.2%. And then I mentioned financials and industrials. So you sort of have this built-in hedge by being in international markets alongside of some of those growth tailwinds and valuation tailwinds. So we think that that could be pretty powerful. And then looking at valuation specifically, pretty much every single sector that we make a comparison on is cheaper globally than it is here in the US. So again, we're not calling for the demise of technology or saying that AI isn't going to continue sort of pushing the market a little bit higher here, but we do think it's time to start thinking out, dipping a toe into some of these other markets. And so far here in 2026 and back in 2025 in the early days of last year, those markets did do very well based on a lot of these dynamics. So to shift a little bit into interest rates, and I talked a little bit about this, but we've had very, very stable interest rates. And so before we got into, again, this past week, we had some of the lowest volatility measures when we were looking at longer term interest rates that we've seen in history. Now that blew up a little bit this week, but you still have relatively contained interest rates. You look at the 10-year on the left-hand side, right? If we can chop along at these types of levels and we think about what fixed income and bonds do in a portfolio, they give you income. The higher those rates are, the better that income is going to be. So we sort of think about it as returning to that pre-2008 level of what we would say are real yields. That's just the difference between the yield on a bond minus inflation. It used to be about zero, it was even negative for a long time. Now it's about 2%. That's a good return. So we think bonds can continue to do pretty well here. And then if you just look at some of those yield levels on the right-hand side, if you look at sort of corporate high yield bonds, so these are a little bit lower quality, but you're getting about 6.5%. That's a far cry from the 3.5 to 4 you were getting for that type of quality between 08 and 2020. If you look at something like muni high yield and you're looking for a tax haven, you're getting a tax adjusted yield of almost 9.4%. So we think there's some very attractive places to go in fixed income. And we think fixed income and bonds, it's doing its job more than it has in a very long time, right? It's sort of zigging when the market is zagging, and it is providing a lot of that ballast that we've traditionally expected from bonds, but we're pretty disappointed, even in the post-pandemic period, about how that moves. So we're excited about that diversification potential. And to go into some context and kind of wrap up here a little bit, we're getting close to that 30-minute mark, so looking forward to the questions. But if we think about volatility, going back to those valuations, thinking about US markets, we have to approach the market as investors as understanding that volatility is normal, right? There's no free lunch. You're going to move around. So I love this chart because what it shows us in the red dots, those are intra-year declines going back to the 1980s. So if we think, let's go back to kind of that 2023 year, right? That's that 26% type of bump. We had an intra-year drawdown that year of about down 10%. If we go back to 2020, we all know the story there. We had a very sharp drawdown of about 34% before we had a lot of that fiscal stimulus coming back into the economy to really charge up that rally that's helped us to get to where we are today, right? So we should be expecting volatility at these types of levels. And we're trying to prepare our investors, for those moves in markets. And we also think it's going to be a pretty big opportunity to be able to reposition when we see some of those dislocations. And just to take a look at volatility over different time horizons, and this is important to remember as well. We are long-term investors. What I always like to say to our portfolio managers is, it's not what you do in the middle of the crisis, it's what you did before, right? It's where your asset allocation is positioned before you go into a drawdown, before you feel like you need to raise cash, right? And if you think about that in a longer term context, let's just pick something out from this chart. So go to that 5-year, which is, I think, 3 over from the right-hand side. Over 5 years, going back to 1928, 88% of 5-year periods have been positive for an investor's portfolio, only 12% negative. We take that to 10 years, it's 94 and 6. And then 20 years, we've never experienced a negative decline in a portfolio, right? So it's really important for us to keep our wits about us when we get into these dislocation periods and we see a lot of this uncertainty and noise coming from just about every pocket. And so the last thing that I'll end with today is just taking a look at asset class performance over time. So this gets back to what I said about portfolio positioning and how you want to be positioned going into a downturn. Look at how much things have changed. Look at how volatile markets have been when we look at a cross section of asset classes. You've got US stocks leading in 2024, middle of the pack in 2022. You've got emerging market stocks in 2020 up there high. They're the worst performing asset class in 2018. And so we don't know the future. We don't have a crystal ball. We do have a lot of thoughts around where growth is going and where the opportunity set is. But it's important to have a very diversified portfolio. And again, we think that opportunity set to build that portfolio is much more rich than it has been in quite some time. So Dean, I can wrap it up there, and I'm happy to take any questions that anyone has.